Good afternoon, this is Brad Dennis with BIS Commodities and your Friday afternoon video update. It is Friday, January 10th. That means lots of reports today, so today was all about the numbers. First off, first numbers to come out, 89,000 and 6.7%. All right. Non-farm payrolls for jobs came in at 89,000, well below what the trade had expected. The unemployment rate, on the other hand, was down 3%, or excuse me, 0.3%, from 7% down to 6.7%. So, what are you looking at? You're looking at jobs are not being created as fast as what people had anticipated. A lot of part-time jobs out there for the holiday season, and those are being reversed. And you're also seeing the the lack of participation in the jobless sector right now. Has some to do with the extended benefits and those coming to an end for about 1 million people, and then deciding not to look for job and dropping out of the workforce. So when you look at that 6.7%, you look at that and you say, all right, well, that's really not a number that I really need to go by. I need to go by the non-farm payrolls. And we're just not creating the jobs. Private sector was half of what was expected, and that's a little bit disappointing out there. Now, the other interesting part of this whole thing is that the Fed, in its dual mandate, wants to get that unemployment rate to a certain level. Well, it went down today. Didn't mean that it was a rosy jobs picture, but the unemployment rate went down. So do we keep the taper in place, or do we have to adjust that? And I think that that's what the market is kind of hee-hawing back and forth about. We're up about $2 in the SPOOs right now, and I think they're waiting to see if the Fed is going to follow through with withdrawing some of the liquidity out of the system. If that happens, then I think we're really going to start a phase where negative news or negative economic data will really start to hurt the stock market. Until then, though, you're still going to have cheap money out there and guys getting in on the long side. Also, keep an eye on earnings. Earnings season just started. If earnings are not living up to the potential, I think that we could see things back off. So it's kind of a reverse. When we first saw bad news for the equities, you had a lot of people buying equities off of that because, hey, there's going to be more stimulus. They're going to help us out more. Now, if, like I said, the Fed stays to their guns, we could see that tapering or their policy going forward, taking out that liquidity, meaning bad news for the market actually is reflected in lower prices. Other numbers. 222. Let's go with that. 140. Now we're talking about cattle. All right, we had 222 in the addressed earlier this week. We're looking at 140 live bids out there, yet Febs are trading around that 137 level. Seems to be couple packers are kind of scrambling to get product. They've got more money because weights are down because of the cold weather. Now with this warming trend that comes through, are we going to see that money back off a little bit because we're going to be able to get those weights up there again? Possibly could see that down the road. That's kind of what I'm anticipating a little bit. Over in the hog market, a lot of news about PEDV again. PERS is starting to show up in Missouri a little bit too, so it's more about the disease and how those numbers are coming down. Interesting that the USDA still looks at smaller herds in cattle and hogs next year. So it kind of makes you wonder why we're increasing feed usage out of corn for those animals. But we'll get to that too. Like I said, a lot of numbers today. So numbers in for equities, numbers for the livestock. Let's get to the big numbers today, and those were in the ag markets. Sum up, corn, bullish as compared to expectations going in. Beans, neutral as compared to expectations going in, and wheat was just downright negative. They found a lot more wheat out there. So when we look at the actual numbers, about 200 million bushels that came off of the corn carryout, which is going to cause a little bit tighter situation out there. But still, we're talking about 1.6 billion bushels out there. And we have our demand at its highest level. So can we reduce demand down the road? Possibly. I mean, you put a lot of emphasis on that feed number, and we've raised it very high from last year's. And like I said, we were just talking about reducing the cattle and hog herd. So where do they see this higher number? And that's probably one of the few things that threw everybody for a loop today. I would say the increase in feed usage, everybody was looking for a little bit of a pullback in that. And then also we saw yield go down on corn, which is very rare when you continue to increase it as the year goes on. So those are the two kind of wild cards that were thrown at people. So you turned a trade that was leaning to the short side, getting short, expecting a bearish report, not getting a bearish report, having to cover. So now we've got to look at moving averages, and you did take it back up over 430 in the Marches, both its 20-day and 50-day moving average. So you have to respect that. So on the upside, you're probably targeting that 440, 450 area. Now, is cash going to all of a sudden keep with its 20 over and you'll be able to sell 470 cash? That's a question down the road, because you're looking at already basis coming down. So all of a sudden, if we get up to that 450 area, which has been able to buy a lot of corn as of late, we'll be able to see if they continue to buy corn at that level or if they have to increase basis. I would imagine that around here processors would love to go to option price and then be done with all the basis play that is out there. Bean-wise, you had a little bit of a bump up in yield from 43 to 43.3, so that increased your supply. That was offset by demand of 30. So you really just kind of washed your numbers in the beans. They ended up solid today, but it was more about spreading. And the spreading, from what I hear, is they are still concerned about Brazil's ability to get beans out of the country. They're concerned about the logistics down there. Now, going into this year, we knew what a fiasco it was last year. So this year they have already taken measures to try to alleviate that congestion that is seen at the ports. But for some reason today, people are still anticipating a pretty big mess down there. So time will tell. I think if you start to see beans go out of Brazil, you start to see those spreads relax a little bit. And as long as there's not logistical issues, you're probably going to see a lot of cancellations as well. You know, we've been selling some old crop beans, and we're well ahead of pace for old crop beans. But a lot of those contracts have been optional origin, meaning that they can either go through the U.S. beans or they can go South American beans. It was just done with a U.S. company in Bunge and ADM, and we know everybody's down around the both parts. So with South American beans 75 cents cheaper than where we're at, it doesn't take a rocket scientist to find out where they want to go for the beans. But the other thing too is, hey, if we rally ours up there to a high enough point and you're still sitting at the same level down in South America, well, our dollar's got some pretty good buying power compared to the real. We could always look at importing beans, getting up somewhere. So some different dynamics that'll be coming out there. I think you've got to get through January beans and January meal getting off, just in case there is some little short squeeze that's going on there. Get those two off the board, and that's going to be on Wednesday of next week. Then you can come in and you can say, hey, this is the time for South America. South America crop looks great. We had CONAB this week come out and say, hey, CONAB, which is the USDA of Brazil, say, hey, we're at 90, could be as high as 95 for our production levels. And when you look at what the U.S. government has, they have 89 today. So, there's still a difference. So the supply side of the beans can still grow. Weather-wise, a little dry down in southern Argentina, but no matter where you're at in South America, if you have a record crop, you're still going to have a 10% area that's not going to perform so well, and that's kind of where we're at. It's not spreading at all there. Back to the corn and beans a little bit more. You wonder, too, what is going to happen down the road when you look at on-farm storage. On-farm storage for corn, 10 billion, 426 million bushels. Guys have got the bins full. So it's in their hands, and we'll see if they end up, getting out of it, or if it's a basis-driven kind of market where here in, say, Cedar Rapids, we have to go, 30 over. That's what we're going to find out when we get to this corn market, maybe around that 440 area. And you got to look at those technicals. 440, 450 is going to be pretty good resistance. I think with this number, though, it kind of puts in a little bit of a floor at that $4 level for old crop. New crop, different story. If we grow it, you have to expect some lower prices. And it's going to be an interesting year, too, because the next 2 months we're going to be determining some insurance prices, and traders will have to go in there and determine whether or not they want to get insurance, because a lot of guys, if you're looking at a $4 level, it's under production costs. So it could be very interesting over the next month or so. I would suspect probably see some more range trading in the corn market, maybe 410 to 450 or so, until there is some catalyst. Remember, with the demand that they do bring in, you have to keep prices lower to see that demand come through. If prices get too high, then you can bring back that demand a little bit and loosen up the balance sheet. As far as beans are concerned, with that neutral report, I think any opportunity to sell beans over $13, you have to. Kind of interesting that you saw new crop beans under $11 today. You're talking about, once again, South America having a crop come out of there that's twice as big as ours. And then you're talking about guys looking towards beans and wanting to plant beans instead of corn because of the ratio right now. Well, maybe we took care of some of that today with corn rallying and beans kind of staying stagnant. We'll have to see. Now, another side, too, that you got to remember is on this corn market, it's going to be met with some selling. We haven't marketed a lot of corn out there, so still a lot of sales to be made. With that in mind, you're going to have small resistance on the way up there. Also keep in mind, wheat was down about 14 cents today. So corn's up 20, wheat's down 15. You just took that spread closer by 35, so there's going to be a substitution value or a substitution effect going in that market. And remember, winter wheat's going to be coming out before anything else. Also, keep in mind that we did find out in the wheat plantings number today that 1.3 million acres are still up for grab for corn and beans. All right, we didn't plant that to wheat. Plus, we've got another 3.5 million acres that was preventative last year that'll be coming into corn and beans. So, bottom line is what I'm trying to say with this is, hey, let's get that new crop corn up there so we can take advantage of some rallying prices and try to get some good protection on there. So that is all I have for today, going by the numbers. So broadcast over.